Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today is going to be our first midweek market update for February. January was certainly an interesting month. We're going to get into a couple of things today just to kind of show some of those movements that we saw, but really it almost seems like 2020's carried into 2021 with just kind of strange things happening. And so the beginning of January, we saw a really nice advance that kind of started with a very, very strong month. And so this back here, this is kind of representing the S&P 500 looking back 30 days. And so we had a really strong, steady advance throughout the most of the month, actually. And then last week, so you'll remember we had a whole discussion about GameStop and the short squeeze that was going on with individual investors that were running up highly shorted stocks like GameStop and AMC, which was requiring hedge funds to have to come in and kind of chase those performances to cover shorts. If you have questions about that or you want to learn a little more about that, I actually did an entire video just on the phenomena that we were seeing within the short squeeze market. So you can look for that on our Facebook page, our YouTube page. So I did a whole video just on that. But what was interesting is that there was actually widespread implications of these short squeezes happening across the market, and it affected the market negatively. And so what happened is, as these hedge funds needed to now cover all of these shorts that they had to go out and purchase additional shares. So that means that they had to raise capital because they don't just have a lot of cash sitting on the sidelines. And so that means they had to take from areas that had done very well, large cap growth, mid cap growth, tech, these areas have been running up, liquidate, and then be able to go back to purchase. And so we saw repercussions and ripples kind of across the market as a result. And so you can see here, this was kind of like as it started, and down we went. Now we actually sat on the 50-day moving average right here. And so remember, we talk often about how our long-term moving averages act as lines of support for the market. And so we can very clearly see this. I thought this is a good illustration. We came down, kind of sat here, bounced off, and then yesterday and Tuesday and Monday of this week have both been pretty strong advances for the market. Monday was up over 2%, and yesterday we were up over 1%, so we had two outside days there in the positive. So that was good. So the market kind of recovered. Something else, though, that is a bit interesting when we look at just kind of what went on in the market with it was a broad sell-off kind of across the board, and it was kind of hard to figure out why areas were selling off the way that they were. And again, wondering if it kind of goes back to as hedge funds were trying to find those areas that had done exceedingly well and be able to kind of trim back to be able to cover their shorts. Interestingly, though, those areas that got extremely beat up last week, especially Thursday and Friday, are the ones that conversely are doing very, very well this week. So just it's been kind of an interesting movement to watch. As of for today, markets are mixed, not a whole lot going on, hovering between just slightly negative and just slightly positive. So today's been a little bit of a quieter day on that front. So let's talk, though, a little bit about what actually happened for the month of January. And so this kind of shows it just a little more. So you can see we had a very strong advance. The purple line is going to be one of our tactical models. S&P 500 is going to be this orange. But so after this kind of strong advance, S&P 500 actually ended the month down negative 1%. Now, our positions that we held were actually positive 1.72% for the month. And so again, just kind of showing the power of being in those right areas, not just arbitrarily investing across the board, but trying to find those areas of relative strength, steering away from those areas of weakness. This is kind of how that works. But even still, all areas of the market were absolutely negatively affected by that broad sell-off that we saw last week. And so as of this point, markets were up significant, and then you can just see the sell-off there. So repercussions across the board. So you might say, so then what is happening with GameStop and AMC right now? The answer really is not a whole lot anymore. There has been some pretty significant selling pressure on these areas. Not unexpected, because remember, these are areas that should have been kind of like short-term plays for most investors. So as you can see right here, make this a little bigger for you. Here's GameStop back January 4th, January 11th, January 18th. literally doing the same thing that it had done for a year more. And then here's the run up that we begin to see within the short squeeze, some volatility here. Tried to get back up to hit that peak again, wasn't able to hit it. And then, I mean, yesterday really just kind of fell off a cliff. So this is kind of where we're sitting right now. Now today, it is up a little bit again. I think right now, trading at about $100 a share, which is probably still about $70 too expensive for share. So we'll have to kind of wait and see what actually, when the rest of this kind of pans out. A lot of investors at this point have either taken profits and left or have decided to kind of take their losses and go. So remember what I say about when we're chasing a market or chasing a stock, it's all supply and demand, and it's all about buyers and sellers. That's all the stock market is. The stock market is really just a way to bring buyers and sellers together. Buyers looking to buy stocks of companies or ETFs or mutual funds, and sellers who are interested in getting rid of those shares. And it's about coming up to an agreement of price. If the buyers are willing to pay what the sellers are offering for, then there can be a transaction. But what happens here when everybody decides they want to exit, but they want to sell for the prices that they bought for, and sellers have the ability to say, absolutely not, I'm going to wait, because that's not something. And so that's the problem within these short squeezes, is you can't have an infinite amount of buyers. When the buyers begin to dry up, price pressure kind of comes on immediately. And I used the example in my video last week that it's kind of like what happens in a crowded movie theater when somebody yells fire. Everybody runs for the exits, and there's only so many exits, and the problem is that people get left behind, not able to get through. And that is what people, if they haven't already kind of begun to feel, that will continue to feel trying to get rid of these shares. So again, I don't want to spend a whole lot of time on GameStop because I did do a whole blog about it. So you can check that out on our website. That's coming out today, as well as there is a video on short squeezes in general. So I do want to spend some time, just a few minutes, just talking though about what we're seeing here and kind of what it means in general for the market, because what we're seeing now is just such a perfect example of irrational exuberance amongst investors right now. And so right now, investors just collectively have this feeling of FOMO, this fear of missing out, needing to ride the wave, to the point that they're willing to pay $400 for a share of GameStop that shouldn't be trading any more than 30. So we see these things in markets that are acting very irrationally. And so we saw this back in the 1990s and then in the early 2000s, where investors started to kind of treat the market like a casino. I don't even need to go to Las Vegas to gamble. I can gamble all my money right here, and I can double my money, triple my money. And when we see that type of like reckless behavior, just is in general, it's just kind of, it should give us caution. Hey, this is where we are when we're looking at when investor greed is as high as it is right now. You know, the old adage that we should be fearful when others are greedy, and greedy when others are fearful. And so right now, greed is absolutely across the board at all-time highs. And does that mean that we are absolutely at a market top? No, these can go on forever. But as investors, it's kind of our job to pay attention to what's happening out there. And so while the short squeeze that we saw last week was really interesting to watch and sit back and see the fallout, it also was, in my eyes, it kind of concerns me, because it makes me think that the market is even more irrational than it was in the spring. So I leave that with you, that just these are things we need to pay attention to. There are absolutely areas of the market that still, there are sweet spots in the market where we can take what the markets will give us. Now you see back in January, markets were down over 1%, but we were able to find areas that allowed our investment models to actually have positive performance over 1%. So there's areas, if you can find those areas of relative strength and momentum, but just in general, we should absolutely make sure that we're paying attention. So then what do? You want to make sure that you understand why you hold the positions that you're holding. Make sure that you have a buy and sell discipline. That means that you know what you know what needs to happen for you to continue to buy, and you know what needs to happen for you to consider selling. And you need to be able to act unemotionally to that. And that is a big thing, because it's easy to say, well, I know, I'm just going to buy low and sell high. That investors understand that. It's actually harder to do, to actually implement that. And the only way you can do it is to have that plan set up ahead of time. So it's why we use a math and rules-based process. So it takes that emotion out, that when things trigger, we know we can do A or we can do B, and we act on it. So as investors, make sure you know what you hold, why you're holding them, what the purpose of those investments are. We like to say we let our winners run, we cut our losers quick. So if it's not working now, it's probably not ever going to work, especially in a market like this. So just things for investors to consider. Obviously, everybody's situation is different. And so if you have questions, you can always seek out professional counsel. And I will leave you with just my contact information. And so I would love to hear from you. So again, if you are one of these investors who has been participating in these short squeezes, I'd love to just kind of, if you have feedback for me about whether or not the video was helpful, or just in general kind of what happened, because I know that there's a lot of investors who in the short term are actually able to kind of turn around and make a nice profit for themselves. And I would just love to hear from you. I'd also love to hear from you if you have questions. We really are here to help. I love answering emails. I love taking phone calls when people call and say, hey, I have a question about what you said on that video. I don't quite understand it. Or does this apply? Or is this the same type of thing? So you can always reach out to me, AshleyR@victoryfiduciary.com, my phone number and extension. And so if you are in the Northeast, I hope that you are digging out and staying warm. I know we had quite a bit of snow that got dumped on us over the last few days. So I wish you well. And if you're in other parts of the country who did not experience that, then good for you. I hope you're enjoying sunshine and good weather. We thank you so much for joining us today, and we look forward to speaking with you next week. Take care.